Good afternoon, class. Today we're going to discuss Chapter 3 entitled Business Income and Expenses. We're going to cover how to complete a Schedule C and the tax treatment for certain business deductions. And so the learning objectives for this chapter are to complete a basic Schedule C and describe the tax treatment of inventories, transportation expenses, travel expenses, meals, business education expenses, dues and subscriptions, clothing and uniform deductions, explain the special limit for business gift deductions, bad debt deductions, ascertain when a home office deduction may be claimed and how the deduction is computed, and applying the factors used to determine whether an activity is a hobby and understand the tax treatment of hobby losses. And so a Schedule C, the terminology trade or business. A trade or business is not formally defined in the Internal Revenue Code, but it is in general any activity engaged in for a profit. And so tests for deductibility for an expense to be generally considered deductible for a trade or business. It must be an ordinary and necessary expense, have a legitimate business purpose, and be reasonable in light of the fees that are generated as a result of the expenses. And so ordinary and necessary would normally fall in the category of what type of business you're engaged in. A legitimate business purpose, you have to be able to tie it to some type of income-driven activity, and then to be reasonable in light of the fees that are generated. The amount cannot exceed your revenue that you're normally generating. And so the code restricts the deduction of certain expenses such as personal living, family expenses, capital expenditures, expenses related to tax-exempt income, expenditures related to sale of illegal drugs, illegal bribes and kickbacks, penalties, fines, and other payments to governments related to the violation of the law, lobbying, political expenditures, and settlement or attorney fees related to sexual abuse or harassment if subject to a non-disclosure agreement. So a Schedule C, taxpayers who operate a business as a sole proprietorship must file a Schedule C to report their profit or loss. And so there's 5 parts to the Schedule C. The first part of the income, Part 1, expenses are in Part 2, cost of goods sold, Part 3, vehicle information, Part 4, and other expenses, Part 5. And so refer to figures 3.2 and 3.5 on pages 4 and 6 for an illustration of the 5 parts of the Schedule C. Self-employment tax. Taxpayers with net earnings of $400 or more must pay a self-employment tax. They must file Schedule SE with Form 1040. So self-employment tax is made up of 2 taxes, Social Security and Medicare. And so 12.4% of the first $132,900 of net self-employment income. And Medicare tax is 2.9% on net self-employment income. And so there is a 0.9% additional Medicare tax on a certain high-income taxpayers. And so taxpayers that get a deduction for adjusted gross income equal to half of the self-employment tax. And so Social Security and Medicare taxes are covered in detail in Chapter 6. Cost of goods sold is a significant deduction for many retail businesses. Cost of goods sold is calculated as follows. And so this is important. Cost of goods sold equals your beginning inventory plus your purchases minus your ending inventory. And so 2 commonly used methods of inventory valuation are FIFO and LIFO, first in, first out, and last in, first out. If LIFO was used for tax purposes, it must also be used for financial statement purposes. Typically, a majority of people use FIFO, so that's why they're making that statement. Generally, taxpayers must use the accrual method for purchases and sales of merchandise. However, taxpayers with gross receipts of less than $25 million, calculated over 3 years, are not required to keep inventory on the accrual method. And so certain transportation expenses for business purposes are deductible by taxpayers. So deductible expenses include travel by airplane, rail, or bus, the cost of operating and maintaining an automobile, and transportation expenses may be deducted even if a taxpayer is not away from his or her tax home. So commuting is generally not deductible. except in the following three special circumstances: the travel between taxpayer's home and work location outside of the metro area where taxpayer lives and normally works; travel between taxpayer's home and temporary work location if taxpayer has a regular place of business; and travel between the taxpayer's home and other regular or temporary location if the taxpayer home is his or her principal place of business. So in all cases, taxpayer can deduct additional costs of hauling tools and equipment. So transportation, taxpayers must use a standard mileage rate to calculate deduction of transportation expenses, what they may use. So the standard mileage rate currently is 58 cents per mile. The following costs associated with operating an automobile are built into the standard mileage rate. So gasoline, oil, insurance, repair, maintenance, and depreciation. Deductions for all other following are determined separately. And so parking and toll fees related to business transportation, interest on car loans, and personal property taxes. So to use the standard mileage method, taxpayers must own or lease the automobile, not operate a fleet of automobiles using five or more simultaneously, not have claimed depreciation on the automobile using any other method other than the straight line depreciation, and not having claimed a Section 179 depreciation or bonus depreciation on the automobile. And so if taxpayer does not use the standard mileage method in the first year, it is not available for any subsequent year. Taxpayers may choose to deduct actual expenses of transportation. And so the taxpayer may change from the standard mileage method to an actual cost method in any year and must use a straight line depreciation on the automobile if the change is made. And so a taxpayer who use actual cost method must keep adequate cost records. The following formula is used to calculate the deduction when using actual cost method: the auto expense times the business use percentage. And so business miles driven divided by the total miles driven. And so business use percentage is applied to total automobile expense for the year: gasoline, oil, repairs, depreciation, insurance, etc. Deductions for parking and tolls, interest and car loans, and personal property taxes are determined separately. So here they're basically saying if you choose not to use the standard mileage rate, you can deduct the actual expenses for your automobile, but you're going to have to take the percentage and determine what percentage is business as opposed to non-business use. And so vehicle expenses are reported on Form 2016 and are carried over to Schedule C. And so to be deductible, travel expenses must result from a documented business reason. And so deductible travel expenses include meals. The cost of meals is only 50% deductible. If employer reimburses employee for the cost of meals, employer can deduct the 50% of the expense instead of the employee. Also, lodging, taxis, tips, and laundry. Travel expenses are deductible as long as they can be substantiated. They are not lavish or extravagant. The taxpayer is away from his or her tax home overnight. And so overnight does not mean 24 hours. It's defined as a period of time longer than an ordinary workday in which rest and or relief from work is required. A tax home is defined as a taxpayer's principal place of business and is not necessarily the same location as his or her family residence. So expenses of temporary assignment are deductible if it is not practical to return home at the end of each workday. Long-term or indefinite assignments, generally more than 1 year, may require reclassification of a new tax home for the taxpayer. So typically, overnight travel expenditures are limited for a time period. If they're generally over a year, they're not deductible. And so travel expenses deductibility is dependent on whether a trip is classified as business, pleasure, or a combination. If a primary business trip within the United States, all travel costs to and from the destination are deductible. Only business portion of meals, lodging, local transportation, and incidental expenses are deductible. If primarily business trip outside of the United States, travel costs to and from destination are split between business and personal based on the number of days. Any business related expense incurred while at the destination are deductible. If primary pleasure trip within or outside the United States, travel costs to and from the destination are not deductible. Any business related expense incurred while at the destination are deductible. So, an example, Gretchen, a sustainability director, travels from Idaho to New Mexico for a business trip and pays $380 for airfare. The lodging and meal costs are $330 and $150 respectively for the business portion of the trip. While in New Mexico, she goes on a personal sightseeing tour of the Turquoise Trail and spends $400 on car rental and lodging and $85 on meals. What amount may she deduct for business travel? And so here she has some business travel involved with some personal pleasure travel. And so since the trip was primarily for business in the United States, all of the airfare is deductible. The lodging of $330 and 50% of the $150 business meals are also deductible. None of the personal expenses are deductible. And so here you have 380 plus the 330 plus 50% of the 150 equals $785 is deductible, not her private sightseeing part. So no deduction for travel expenses allowed unless the taxpayer keeps proper records. And so taxpayers must substantiate the following: amount of each separate expenditure, such as airfare, lodging, dates of departure and return for each trip, and number of business days on the trip, the name of the city or town or travel destination, and the business reason for the travel. So per diem substantiation. So as an alternative to reporting actual expenses, employers who reimburse employees for travel expense may choose a per diem method. Per diem eliminates the necessity of keeping copious records for travel expenses. Employers can use per diem for travel expenses, lodging, meals, and incidentals, or only for meals and incidentals. Self-employed taxpayers may only use per diem for meals and incidentals. And so per diem works the same way as a standard rate if you're using a vehicle. The per diem is typically a federally set number, depending on the city or state location where you're going, that you can use for meals and incidentals for the day without having to calculate or keep actual expense records. And so two per diem methods to substantiate travel expense. The standard meal rate method, employers allow per diem amount travel equal to the current federal per diem rate, which varies based on travel location. Per diem amounts for each area of the United States are available at the U.S. General Services Administration website. And the high-low method. It is easier to use if employees travel extensively. A small number of locations are designated as high localities, and other locations are low cost areas. And so once this method is chosen by an employer for an employee, it must continue throughout the calendar year. So meals and entertainment. So starting in 2018, there is no deduction for an activity generally considered to be entertainment, amusement, or recreation, membership dues for any clubs organized for business, pleasure, recreation, etc., a facility used in connection with any of the above items. And so entertainment costs related to recreation, social, and similar activities for the benefit of employees remain deductible. A meal related to an entertainment event is only deductible if the meal is purchased separately. So see page 17 in Chapter 3 for a table outlining deductibility percentages for different situations. And so dues paid to professional organizations or to civic or public organizations are allowed as legitimate business deductions. And so educational expenses. And so note, tax law for educational expenses has become very complex. So this section deals primarily with the deduction of continuing education expenses incurred by self-employed taxpayers. Qualified tuition programs, education saving accounts, education tax credit, and education loan interest are discussed in other chapters of the text. The suspension of the deduction for miscellaneous expense subject to 2% of AGI has effectively eliminated the deduction of reimbursed educational costs for employees. So educational expenses. Educational expenses may be deductible if one of the two tests is met. The educational expense must be paid to meet the requirements of the taxpayer's employer or the requirements of the law or regulation for keeping the taxpayer's salary, status, or job. The educational expense must be paid to maintain or improve existing skills required in performing the duties of the taxpayer's present work. And so expenses of travel for educational purposes, travel expenses incurred while away from home for trips that are primarily to obtain qualifying education are deductible. So as an example, Roberta is a paralegal who attends law school at night at the University of Texas at El Paso. Are her educational expenses deductible? Assume that 30 hours per year of continuing education are required for paralegals to maintain certification in Texas. If Roberta flew from her home in El Paso to a continuing education conference for paralegals in Dallas, are her expenses deductible? And here, remember, it has to follow the two tests. The educational expenses must be paid to meet the requirements of the taxpayer's employer or the requirements of law or regulation to keep the taxpayer's salary, or the educational expenses must be paid to maintain or improve existing skills. And so the costs of attending law school are non-deductible because the education would qualify Roberta for a new trade or business as an attorney. Her expenses at the conference would be deductible and meals at 50% only, since she is complying with requirements to maintain her existing job. So the second situation, she's maintaining her salary per the first requirement. The second one, it actually would qualify her for a new job, so it's not deductible. Dues, subscriptions, and publications. So professionals who are engaged in a practice or employers may deduct the cost of related dues, subscription, and publications. Included in the category of deductions are items such as dues to professional associations, cost of subscriptions to any journal that is directly related to the taxpayer's profession. Special clothing and uniforms. They are deductible if they are required as a condition of employment, if they are not suitable for everyday use, if the clothing or uniforms qualify the cost of purchase, alterations, and laundry are deductible. And so in this situation, normally some professions, if you're required to wear a uniform that normally has a name tag or something that where you wouldn't wear it every day, it's deductible. But if it's just dress clothes like a suit and things of that nature, for some professions, it's just not deductible because you can wear it every day. Business gifts. Taxpayers may deduct business gifts up to $25 per year per donee. Husbands and wife count as one donee. There's no limitation for small business gifts up to $4 each if taxpayer's name or company name printed on the gift items. A deduction for gifts of tangible personal property made to employees for length of service of the job. Safety achievement may be deducted up to a limit of $400 per employee per year. And gifts to taxpayer supervisors are not deductible. So bad debt. Bad debt arises when a taxpayer sells goods or services on credit and the accounts receivable later becomes uncollectible. And so a deduction for bad debt is allowed up to the amount that was previously included in income. And so taxpayers must use the specific charge-off method. The IRS requires proof that the debt is worthless as well as the amount of the worthlessness. Business and non-business bad debts. So debt arising from taxpayers' trade or business are classified as business bad debts. Other debts are considered non-business bad debts. Business bad debts are ordinary deductions. Non-business bad debts are short-term capital losses, which are netted against other capital gains or losses, and are subject to a $3,000 per year loss limitation. And so the treatment of capital gains and losses is discussed in detail in Chapter 4. So as an example, for bad debt, Kiko, a dentist, loaned her friend Lars $20,000 to start an upholstery business. Subsequently, Lars cannot repay Kiko, and so this is a business or non-business bad debt. How much may Kiko deduct in the current year? And so it's pretty obvious here this is a non-business bad debt, as Kiko is not in the business of loaning money. It is a short-term capital loss limited to $3,000 of deduction against ordinary income in any 1 year. Office in the home. A home office is generally not deductible. However, deductions for business use of home is allowed if the following 4 items. The home office is used by a self-employed taxpayer as his or her primary place of business. The home office is used exclusively on a regular basis by patients, clients, or customers in meeting or dealing with the taxpayer in the normal course of trade or business. The home office is a separate structure not attached to the dwelling unit and is used exclusively on a regular basis in the taxpayer's trade or business. The home office is the storage space of a business inventory or product samples. And so the TCJA suspended employee business expenses, therefore home office for employees, even for the convenience of the employer, is no longer deductible through 2025. It's an important note. And so the income limitation, the home office deduction cannot be used to create a net loss for the business, except if the loss is due to the allocation portion of mortgage interest and property taxes, because they're generally deductible anyway. The other costs of operating a home, which are included in the home office allocation, include rent, home insurance, repairs, cleaning, utilities, homeowners association dues, depreciation, and any unused deductions can be carried forward to offset income in future years. So, as an example of office in a home, Kitty, a part-time cartographer, maintains an office in her home where she coordinates GICS projects and keeps client records. She allocates $12,000 in mortgage interest and taxes to her home office and collects $11,000 in fees. Assuming no other business expenses, what is her current year home office deduction? Will she have a home office carry forward? How would this change if she allocated $2,500 in maintenance and utilities? Assume Kitty does not use the simplified method. And so here right away you notice that she's allocating $12,000, which is more than what she's collecting, $11,000 in fees. And on top of that, she's trying to allocate an additional $2,500 in maintenance and utilities. So in Kitty's situation, assuming that no other business expenses, Kitty's current home office deduction would be the entire $12,000 with no carry loss forward. However, she would not be able to deduct the additional $2,500 in maintenance and utilities, as she is limited to the gross income derived from the trade or business, resulting in a $2,500 home office carry forward. And so here, remember, you're limited. The home office deduction cannot be used to create a net loss for the business except for the loss due to allocation of the portion of mortgage interest and property tax. And so here, the reason why she's allowed to use the $12,000 is because it specifically says it's mortgage interest and property tax. The $2,500 is not, and that's why it's a carry forward. Otherwise, it should be limited to the $11,000 of income. Home office allocation. The calculation of home office expenses involves the allocation of the total expenses of a self-employed taxpayer's dwelling between business and personal use. And so the allocation percentage is calculated on the basis of square footage. And so percentage equals the home office square footage divided by the total home square footage. And so self-employed taxpayers claiming a deduction for home expenses are required to file a Form 8829, expenses for business use of your home. And so basically they're going to make you divide out the percentage to find out the square footage that you're actually using in your home, and that's the percentage you're going to use against the expenses of your home. And so there's an optional safe harbor method. A simplified home office deduction is now available that allows the taxpayers to take a $5 per square foot as a home office deduction with a maximum of $1,500. Any deduction in excess of the income limit may not be carried forward, again, per our previous example. So hobby losses. So under hobby loss provisions, taxpayers may not show a loss from an activity that is engaged in not for profit. And so a hobby income is reported as other income on line 8 on Schedule 1 of Form 1040. And so basically a hobby is something you're entering into where you're not trying to turn a profit. And so operational rules. Taxpayers can avoid hobby loss rules if they can show that the activity was conducted with the intent to earn a profit. The factors that help determine the profit motive are as follows. So these things are important because normally what happens if you have a business or you're trying to start a business and you just consecutively have losses, the IRS may say that this business is just a hobby. And so that's why these factors are important. And so whether the activity is conducted as a business, the time and effort expended in the business, dependence on the income of the taxpayer's livelihood, whether losses are due to circumstances beyond your control, attempts to change methods of operation to improve profitability, previous success of the taxpayer in similar activities in the past, whether the activity makes a profit in some years, whether the activity is expected to make a future profit from the appreciation of the assets used in the activity. And so tax law provides a rebuttable presumption that if a taxpayer can show a profit from the activity for 3 out of the 5 previous years and 2 of the 7 previous years, if it involves horses, then the activity is engaged in for a profit. And so loss limitations, miscellaneous hobby expenses are longer deductible. And so that's why it's important, because if it's deemed a hobby, you won't be able to deduct any of your expenditures. And so that brings us to the end of chapter 3. Please reread the chapter in the text and look over the slides and the other material available in Moodle. Thank you.